Hey, I want to welcome everybody back to the Confident Retirement Podcast brought to you by LPF Advisors. I am your host, Chris Flaming. Joining me are my two sidekicks. Two heads is good, three heads is better than one, and three heads is better than two. My fellow resident advisors, I have Armando and Colin. Hey, guys.
How you doing?
Hey,
Good. So we're starting a new series this week for Henrys. Those aren't people in our family that we can't stand. What is a Henry? We're going to plan to break all that down, give you some smart money strategies for high earners, not rich yet. If you're making a solid income, but you don't feel like you've got total control of your financial picture yet, you're in the right place. So over the next several weeks, we'll discuss the most common financial planning challenges faced by Henrys. More importantly, we'll talk about what you can do if you're a Henry to overcome them. But first, I want to give you our quick disclaimer. The information we provide is our opinion, not necessarily that of our firm or the platform. We give general information only on the podcast, not any customized investment advice. Nothing should be construed as legal, tax, or financial advice, and you should consult with your own professionals about your personal situation. So, Colin, go ahead and take it away.
always. Thank you, Chris. I appreciate it. So let's start out with what a Henry is and some of the common characteristics that Henrys might have.
Yeah, nice to see both of you again. So a Henry, I can just break down the abbreviation. So a Henry is short for, like Chris mentioned, high income or high earner, and you're not rich yet. So simply put, this is someone who has a high income but are not rich yet by our cultural standards. So it's someone who is making a great income but may not have the built up liquidity or assets to feel rich yet. So Henrys usually find themselves able to comfortably support their lifestyles. Things like debt, high expenses, taxes, and limited liquidity can restrain a Henry from moving towards that wealthy category. So preventing bad habits or decisions before they snowball can help a Henry make fast progress. So let's take a deep dive into where we think Henrys should focus. And I think one of the biggest ones is going to be taxes here. So if you're making six figure, Uncle Sam's love you, but not in the way you want. High earners often find themselves in higher tax brackets, which means you could be given a huge chunk away of your hard-earned money. So, Colin, can you just tell us what we could do to, minimize our tax implications?
Yeah, that's a great question. So first thing that we want to look at is maxing out those tax advantage accounts. So those are going to be your 401ks, your backdoor Roth IRAs, because you make too much money to directly go into a Roth IRA. We also want to consider strategies like tax loss harvesting. So investing your money in that after tax bucket. A lot of high income earners, they're going to max out the 401k, they're going to do the Roth money, but then we have to look for other areas to place our money, which is going to be that after tax or investment account. But if you have stock options, make sure you understand those tax implications before you cash out. And then, a little planning can save you thousands.
Yeah, no, that's great information, great strategies. You couldn't have said it any better. And going forward, so our next one that we see that Henry should focus on is definitely lifestyle inflation. That's also known as, lifestyle creep. You get a raise and suddenly your expenses rise just as fast. You're tempted to buy the fancier apartment or car, the luxury vacations, going out to eat more, the expensive diners. It all adds up quickly. So, Colin, how can we avoid this lifestyle inflation, this lifestyle creep?
Yeah, so it's easy to spend those bigger checks when you see them come in, but here's the key. Be intentional with your spending and know high income doesn't mean wealthy. It's not what you make, it's what you keep. So set up those automatic savings before upgrading your lifestyle. Use that pay yourself first approach. So if your income increases or you get a bigger bonus, bump up your investment contributions before buying that new car or getting into that bigger house.
Yeah, great information. It's really all about priorities. And here's another challenge that we see many Henrys could also be cash poor. So your money could be tied up in retirement accounts, not accessible real estate or company stock. So they don't have enough liquid cash for emergencies or opportunities to invest in other things. So what's the fix for this of being cash poor? What's the routine to get out of this?
Yeah, so that's a great question. The biggest fix is keeping at least 6 to 12 months of expenses in something like a high yield savings account, treasuries, depending on how much time we have. Also don't overinvest your assets into illiquid things like company stock or long-term real estate unless you have a solid cash cushion. So Armando, the other big thing that we see is debt, which is a major issue, especially in student loans for professionals like doctors, lawyers, and even MBAs. So even with a high income, monthly payments can feel suffocating. So how can we help eliminate that dilemma?
Yeah, great question. Those student loans get to you one way or the other. But yeah, if your interest rate is high, we can look at credit card loans also. Refinancing could lower your payment. So that's one avenue to take. And if you're juggling multiple debts, use the avalanche or snowball method to pay them down strategically. So the sooner you free up the cash, the sooner that you're able to invest this money and do things that you would like.
Absolutely, and I appreciate that. So many high-income earners make the mistake of putting too much money into one investment, like company stock or speculative assets into crypto or commodities. While it's tempting to chase those high returns, a lack of diversification can usually be risky and end up poorly for us. So where should we look to diversify, Armando?
Yeah, this is very important. You definitely want to stay within your risk tolerance profile, having a good balanced portfolio. So using a mix of diversified mutual funds, exchange traded funds, or real estate and other assets could help diversify your portfolio. And another thing, if your company offers stock options, don't hold too much. Your paycheck is already tied to your employer. So no real reason to double down. But more of the story, stay balanced and stay within your risk tolerance, and diversifying can definitely help that.
Absolutely. So Henrys often delay retirement planning because they assume their income is always going to stay high. But without a strategy, you could miss out on years of tax-free growth in retirement accounts. So Armando, what strategies should they implement now so they don't have any blind spots in their financial planning?
Yes, this is also important. This is another thing where we see a lot of blind spots. People think they're very prepared for every situation, but lack of, making sure that your tax advantage accounts and looking at options like a backdoor Roth. And also don't forget about insurance. Disability, life, and umbrella policies can protect your assets as they grow and protect those blind spots like Colin mentioned.
Catching those blind spots, that's a big thing we do for clients that we work with. I think they got it all figured out, but there might be some things that you're not seeing or forgetting about that we can help with. So there you have it. Some of the most common financial pitfalls that Henrys face. The good news is a few smart moves today can set you up for long-term wealth. And as I mentioned, over the coming weeks, we're going to deep dive into some of these problems, go a little bit deeper on the solutions that we feel like would be helpful for that group of people. If you found this episode helpful, make sure to subscribe and share it with a friend who's also in the Henry Club. And if you have more questions about this or any other financial topics, feel free to reach out at lpfadvisors.com or email us at info@lpfadvisors.com. We thank you for tuning in and watching. We'll see you next time. And then till then, take care, be well. Thank you, Colin and Armando.
Yep. Thank you, Chris.
Thank you.
You've been listening to the Confident Retirement Podcast with Chris and Mark from LPF Advisors. For more information on them and retiring confidently, please visit lpfadvisors.com. If your ears are pleased and your mind is now at ease, do share the program with your friends and subscribe wherever podcasts are found.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.